The M&A cycle continues to heat up in the Canadian mining markets, with yet another week starting off with a fresh transaction on the table. And now the majors seem to be getting antsy to start buying up some of the mid-tier producers, with Pan American Silver agreeing to acquire Meg Silver, who has a rather large joint venture in place with Fresnillo in Mexico. Let's dive in. Pan American Silver is looking to add ounces to its reserves and production profile, with the company announcing this week that they will be acquiring Meg Silver in a transaction valued at $2.1 billion US. The purchase will add a minority interest in the Juanicipio joint venture to Pan American's portfolio, providing the company with a boost to their annual production profile while also partnering them with Fresnillo, the world's largest producer of silver. On top of that, they'll also take ownership of the Deer Trail and Larder exploration properties in Meg's portfolio, providing potential exploration upside for the company. For Meg shareholders, those who elect to receive shares in Pan American, meanwhile, will continue to have exposure to the Juanicipio asset, alongside 10 other silver and gold mines spread across the Americas, which in turn effectively de-risks their investment in what was previously a single asset producer. So, what do the terms look like? Under the terms of the arrangement, Pan American has agreed to pay $2.1 billion US for Meg Silver, which equates to a 21% premium versus the closing price of Meg on the day prior to the announcement, and a 27% premium to the 20-day volume-weighted average price of the equity. On a per-share basis, consideration will amount to $20.54 for Meg shareholders, with shareholders having the option to receive consideration in the form of cash or shares of Pan American. If taking the consideration in the form of shares, the exchange ratio works out to about 0.755 common shares of Pan American for each share of Meg held, with Pan American expecting to issue approximately 60 million shares in connection with the transaction. The company has also capped the amount of cash considerations to be issued at $500 million, so consideration here is subject to proration. Post-transaction, Meg shareholders will hold about 14% of the resulting company on a fully diluted basis. Directors and officers have, of course, agreed to vote in favor of the transaction. However, it was not disclosed what percentage of total votes have been secured in favor of the deal. The transaction is expected to close in the second half of this year, which of course is subject to both shareholder and regulatory approvals. Let's take a quick look at Meg's main asset, which is their Juanicipio joint venture. The joint venture, in which Meg holds a 44% interest in, concerns the large-scale, high-grade Juanicipio mine, which is operated by Fresnillo, whom owns the remaining 56% interest in the venture. The 4,000-ton-per-day operation is focused on a silver-gold-zinc-lead epithermal vein system found within their larger Fresnillo silver trend in Mexico. The mine last year processed a total of 1.3 million tons of ore, which had an average head grade of 468 grams per ton silver. That ore translated to 18.6 million ounces of silver production, alongside 39,000 ounces of gold, with average silver recoveries of 93%. The operation is so big that despite being a minority owner in the joint venture and not being the operator, Meg Silver was able to bill itself as a Tier 1 silver producer. On top of that, Juanicipio is a low-cost producer. Cash costs in 2024 totaled just 88 cents an ounce, while all-in sustaining costs were $5.54 per ounce of silver sold. Free cash flow on a 100% basis in 2024 totaled $292 million, which translated to a $119 million payday for Meg, who effectively had to do nothing for that cash to come in. As for 2025, the asset is performing even better. Q1 saw 4.5 million ounces of silver produced, and on an equivalent basis, that figure jumps to 6.5 million ounces. Cash costs were actually negative 91 cents per silver ounce sold, or $8.50 per silver equivalent ounce sold, while AISC was $2.04 per silver ounce sold, and just $10.64 per silver equivalent ounce sold, which resulted in Q1 free cash flow of $77.4 million for a single quarter. That translated to a $33.9 million payday for Meg Silver in Q1. Guidance for the entirety of 2025 is calling for total silver production of 14.7 to 16.7 million ounces, of which 6.5 to 7.3 million silver ounces are attributable to MEG. Cash costs, meanwhile, have been guided to be from -$1 to +$1 per silver ounce, and all-in sustaining costs are to be in a range of $6 to $8 an ounce. On a byproduct basis, AISC is expected to be in a range of $8.50 to $9.25 an ounce. All right, so let's wrap it up. This transaction isn't entirely shocking. We've highlighted within our earnings coverage on MEG Silver just how good of a deal this joint venture is for the company. They rake in tens of millions in cash flow every year without having to really do anything here. The biggest risk to shareholders basically was the life of mine of Juanicipio, which is still years away from being a problem. Perhaps the more shocking thing here overall is that Fresnillo didn't want to just acquire MEG instead so that they could keep all that cash flow to themselves. All right, everybody, thanks for watching.